It's my privilege to introduce the speaker. CA Narendra J Jain, advocate, is a commerce graduate and a fellow chartered accountant. He is also a company secretary and holds a bachelor degree in law. He currently practices as an advocate before Karnataka High Court and ITAT. He has experience over 20 years in handling tax litigations, advising clients in income tax, transfer pricing, corporate tax, international taxation, and GST. He has authored analysis on transfer pricing judgments published by CCH, co-authored book on digital commerce and analysis of taxation aspects and emerging issues published by IFA Bangalore subchapter. Co-authored book on permanent establishment is emerging trends published by CTC and Taxman. Co-authored book New Age Assessment, Penalties and Appeals published by KSCA. He is part of revision team updating Sampath Iyengar's commentary on income tax 13th edition. He is a regular speaker at various conferences, workshops, study circles, National Academy of Direct Taxes, etc. He is chairman of International Fiscal Association Bangalore subchapter from 2023 to 2025. He is currently the joint secretary of Bangalore ITAT Bar Association. He was convener of Bangalore subgroup of Chamber of Tax Consultants, Mumbai, for the year 2019 to 2020. With this brief introduction, I introduce the speaker for the session. Thank you.
Good afternoon. So after a long lunch session, the objective of this session is to keep you all awake. So if I'm being successful to keep you awake for next 1.5 hours, I'm sure there will be some value addition both for me and you. So this third session, which we are talking of transfer pricing documentation, transfer pricing compliance and documentation. And then there's a next session of TP certificate, 3CEB, right? These two sessions will help in terms of what compliances all of us have to do in the month of October for the clients who are having international transactions or SDT, specified domestic transactions. This 90 minutes, I will try and focus on the transfer pricing study part and how to go about the computation of ALP. What are certain important aspects of going about the computation of ALP and what care we should take in the transfer pricing documentation. TP study, which is a general word we use for transfer pricing study. The law uses the term documentation in Rule 10D, read with section 92D. And why this is an important part of TP compliance is because this is a study or this is a report in which the assessee can articulate his position. What are the transactions or what are the positions or why a particular business model is adopted, why there is a loss or why a particular international transaction has been entered in a particular manner. So this is a place where the assessee can put forward articulate his position in the document. No doubt the TP study per se, we are not filing with the tax authorities along with 3CEB, and it has to be given to the tax authorities when the notices come under 92 CA, reference is made to 92 CA, and the notice comes and the assessing officer or transfer pricing officer asks the TP study. But preparing a proper TP study and preparing a proper documentation will ensure that the position which is taken is properly articulated. Because there could be a lot of unique features. As we go forward into different rules, we will see that there could be a lot of unique features which are attached to a particular assessee, which need to be brought out vis-a-vis the comparables. Right? There could be a lot of such things. As we go forward, we will see that. And if you see the burden of proof under TP litigation in India, as it is set by the special bench, 5-member special bench in STAC, it is on the assessee. So the burden of proof to compute ALP is on the assessee. So how do assessee first discharge his burden of proof? It is by the TP study. It is by the TP study, it is by the TP certificate. This is what is the first step for the assessee to say that why I have done a particular transaction and why I have done that transaction in a particular manner. So that is why it is necessary that TP studies are taken seriously, and it should be done in a manner which reflects the real business scenarios which the taxpayer or the assessees are facing. Now the rule or the genesis of TP documentation comes from section 92D, which mandates the having a proper documentation, which is then prescribed in rule 10D. And rule 10D gives us a detailed analysis which is more or less in line with the international standards that are set for TP documentation. And if this study is properly done, it will also work as local file for the international, wherever there is master file or local file requirements at international level also, it will be useful for that purpose also. The documentation, as we see in 92D read with rule 10D, expects us to maintain the documentation contemporaneous. That means when I am actually filing the certificate, not when I am actually getting the notice from the assessing officer or transfer pricing officer. So it is necessary that this study is somewhere, or this basis at least is there. Because if you see the TP certificate, what are we certifying? The assessee has maintained the TP documentation. That is one of the certification all of chartered accountants will be doing, saying that this is a TP study or documents are maintained as prescribed in 92D, are maintained by the assessee. And if that underlying basis itself is not there in the form of a study, then the certificate, which is reflecting that the documentation is maintained, may not reflect the correct position. Therefore, it is necessary that while returns are being filed, when the certificates are being signed, this set of documentation, at least the basic one, is ready with the assessee. Not maintaining these documents attracts 2% penalty, 2% of the value of international transaction. That is another reason why it is necessary that documentation should be in place. We can broadly say that documentation has two parts in this. There could be, if the businesses are continuing business, which are there, so sometimes you'll be doing TP study for the first time, but many a times it will be just be doing what you have done in earlier years. We have also seen a lot of times people come back and say that why every year TP updation is required, or why every year new TP study is required. This is given in the rules itself. Where there is no significant change, from the businesses from the earlier year to the current year, then the documentation which is there in the earlier year is no doubt useful for the current year. There is no doubt on that. So therefore, there are two parts to the study. One is the basic fundamental part, which will contain the profile of the taxpayer, functional analysis. Those parts may broadly remain same year on year, unless there is a, say, new product launch or new factory setup or a new line of business that comes up. That part generally may remain same for few years. But there is another part, which is the computation of ALP. Now, computation of ALP naturally is based on the figures of current year, based on the transaction of current year. So this part of computation of ALP, which is otherwise also called as comparative analysis, it is called as economic analysis, whatever name you give, this is a part which will change year on year. This is not something which, if you have done last year, you can similarly say that this year also it is the same and I will not update it or I will not change it, right? So the confusion in terms that TP documentation may not be required year on year may not be a correct proposition. I understand to the extent of a part which deals with the profile and functional FAR analysis, that part may remain same year on year, but the part dealing with the economic analysis and comparability analysis, that need to be revisited every year. Even when it comes to functional analysis and profile of the group, every 3 to 5 years one need to see whether there is any change, or at least every year the confirmation should be taken from the client that these aspects, whether they remain same or whether there is any change, fundamental change in the business or not. Because there could be businesses which are discontinued, there could be new service lines which are added or new product lines which are added. So it is therefore necessary that these aspects are taken care when the TP study for a particular year is done. Coming to Rule 10D, Rule 10D basically has 3 levels of documentation requirement. What are these three levels? One is the entity level data. What is the information related to entity? Then there is a transaction level data. That means what are the transactions which have been undertaken in that particular year, in that particular assessment year, the transaction level data. And third year is the benchmarking, or we can call it comparability, or we can call it economic analysis. That is the third segment. So these are the broad classification in the way the Rule 10D has asked the information. No doubt it goes from clause A onwards, but this is the broad level of information that we should keep it in mind: entity level information, transaction level information, and comparability analysis or benchmarking analysis. We'll try and understand what are these information which are required, what are the informations that we should collect, and what are the things that we should really put it into the TP study. Apart from that, there is also a requirement of master file and CBCR. We'll see if we can cover that, but then we'll try and focus on this because this is the main compliance. Now, when we come to the first entity level data, what is the entity level information that the rules provide for? Now, if you see Rule 10D 1A itself, and the relevant rule here is 10D 1A, which expects us to give certain information. What are those information? Ownership structure of taxpayer, ownership structure of the group, and how members of the international group are connected to the taxpayer. That means the ownership linkage. So what is the information required here is, one, what is the ownership structure of the assessee? Now that could be the basic shareholding pattern in a company. If it is an LLP, who are the partners in that LLP, partnership firms who are the partners in there. So this is the ownership of the assessee, entity which we are reporting. That is the ownership structure of the assessee. Now here you can also bring in an aspect that in case there are change in the ownership structure, that also can be reported as a part of this requirement, because many times in the assessment we have seen this is a direct question that the assessing officer asks, whether there is a change in the shareholding of the assessee. Now why the change in shareholding of the assessee may not have a direct implication on the ALP computation or for the transfer pricing purposes. It may not have a direct implication because the transaction level benchmarking is for the company, not for the shareholders. But the reporting requirements may change, because if suppose there is a new shareholder who is coming with 26%, then the AE relation, there could be a new party which is an associated enterprise, right? So that transaction reporting also becomes important. So therefore we have to keep it in mind whether there is any new AE relationship coming up because of change in shareholding. That is one part of it. Second, change in shareholding, if there is a transfer of shares between Group A and Group B, then that can result in a situation where there could be a capital gains issue because there are shares of Indian company, that is indirect transfer or direct transfer issues may come up. Though that is not a TP issue, but this is something which we'll have to be aware of when we are preparing the TP study, right? So who are the shareholders? The group structure. It is always important and necessary that you ask the clients, give the group structure. So this will give you an idea who are the shareholders and who are the sister concerns or who are fellow subsidiaries, because that helps in proper reporting. For example, if there is a shareholder who is my direct shareholder who holds more than 26% in the assessee, the A relationship will fall in clause A, 92A to A. The 92A to A will say that who is the associated enterprise, and the clause A there will say that person who is holding more than 26% or more than 26% of voting power of the assessee becomes an associated enterprise. So someone who is holding me directly or indirectly will become AE under clause A. But what happens to people who are my fellow subsidiaries? Under which clause they will come? They will come under clause B, right? Because clause B of 92A2 will provide that if there is a more than 26% held by the same shareholder or same person, then you become a relationship. This relationship reporting becomes important in 3CB, because 3CB specifically asks you under which clauses. So if you see 92A2, there are clauses A to M, right? Now A to M are different relationships, and clause A is a direct shareholding, clause B is a fellow subsidiary kind of a situation. So you have to correctly select from the drop-down menu in Form 3CB which AE relationship is triggered. This becomes important because then if it goes matter into litigation or assessment, then these aspects also become important. So therefore, for you to ask a group chart would help you to determine under which clause of 92A the AE relationship is coming. So that is one aspect which will bring out see, these are all connected. TP study and 3CB are connected. So for us to understand, one will help us to report the other also. Therefore, having a group chart, how the relationships are there will help. Now, this is, we are talking of a company which is having parent outside India, but it could also be subsidiaries outside India, because a lot of Indian companies today have transactions with their subsidiaries outside India, right? The best way to get the information is the investment schedule of the associate itself. From the annual report, you will be able to get that who are its subsidiary, where it has invested. But when you go to step down subsidiaries, you will not be able to get it from the investment schedule of the taxpayer. Therefore, the group chart will help you to identify who are the associated enterprise, maybe upwards, maybe downwards, whatever it is. That information will be easily available from the group chart, and it is a very important part of the TP documentation. So once you have taken that, that helps you to determine, satisfy the conditions of clause A or reporting conditions of clause A. So where all this information can come from? One, group chart. One, it can come from the annual report, shareholding pattern details given in the annual report, investment details given in the annual report, and related party schedule which is reported in the annual report. Now, many a times will happen that the related party schedule reported, or the entities which are reported in the related party schedule, and there could be mismatch between the what we are supposed to require for TP purposes. Also, you can have another leg of confusion when you have 40A2, related party under 40A2. For example, the related party under 40A2, the shareholding is 20%, right? Whereas the related party for TP purpose is 26%. So there could be parties which may fall within 20 and 26 if it is a large group. If it is a large group, there could be parties which are falling in 20 and 26. You may not report them for transfer pricing purposes, but you'll have to still report from them for tax audit purposes. So these are the aspects which will come up. Once you have the related party schedule in front of you, which is reported in the financial statements, and you connect it with the group chart along with the shareholding pattern, there will be scenarios, these kind of scenarios which can come before you, which you will have to be aware of. Additional data, if you want to go into further details in terms of additional data, then you can always ask the CBCR and master file from the client if they are supposed to maintain. They are not that everyone is supposed to maintain that. Master file requirement kicks in if the consolidated group turnover is above 500 crores. CBCR kicks in if it is more than 6,500 crores. So not that everyone will be having it, but in case the groups have this requirement, that can also be forming part of the your requirement list when you want to report this information, So these are the points for the clause A, which one has to be taken care and which one has to report in the TP study. Now we come to the next point. Profile of the group. If you see rule 10B, 10D, 1B and clause C, clause B and clause C, it asks about various, what is the profile of which the group is, which the assessee is part of the group. So if the assessee is part of a XYZ, okay, one more point before we go further, what I missed in the first slide is, now when we are reporting the AE relationships in the TP study, it is what you need to report is the AEs with whom you are having transactions. Because in a large group, suppose there is Reliance which may have 1,000 subsidiaries. And if you give the list of all 1,000 subsidiaries, that will be a big document. That is not what is required. What is required is the entities with whom you are having transactions. Those are the entities which should form part of your TP study. It is not necessary for you to report every other entity which is part of the group. Only the entities with which there are international transaction, or if there is an SDT applicability, which is an SDT is coming, only that should be coming in the TP study, and not the entire list of the entities with whom you may not even have a transaction. Okay, now coming to point B, sorry, point B and clause B and clause C of rule 10D1, what is the requirement here is what is the expectation here is, what is the group profile, and what are if the assessee is part of a group, then that group of which assessee is a part, the profile of that group, and the taxpayer's profile. What is the taxpayer's profile? Now, this is the information basically which will come in the second set of entity level data, Here you can look at some aspects like what are the product lines or service lines of the group, right? What are the geographies in which the group is operating? What are the main product and main revenue lines? What is the broad business process or broad business cycle of the group, right? And then you can give the ownership linkages which can come as a part of also details here, ownership linkages and brief description of entities which are forming part of the group with which the taxpayer is having transactions. So these are the next set of information which will be critical here. Now here again, from where you can get the information? You can get information from various sources, and what you need to report is also important. Because many times we have seen there will be a confusion in terms of what the assessee is doing and what the group is doing. What the group is doing and assessee may be doing maybe a different activity profile. For example, if there is a large car manufacturer group, the Indian company may only be doing IT services for the car manufacturer. So though you will give a group profile of the car manufacturer as a part of your TP study, but when it comes to taxpayer, you will have to be very specific what is the activity of the group. Not necessarily the activity of the group will be same as what is the activity of the Indian entity is not necessarily the same what is the activity of a group. Many times we will see, for example, the group is doing an activity or the business of digital marketing, but the Indian company is only doing the platform development or the software development for that. So Indian entities, for purpose of benchmarking, for the purpose of characterization, is the software developer. Though the group may be into digital marketing, but when you are doing the benchmarking of the Indian entity, we are looking at what the activity is, that is the software development activity. So similarly, when you are looking at this part of the study will bring out these aspects, should bring out these aspects, this part of the study, that what is the group doing, what is the history of a group briefly, and what are the product lines, service lines, markets you are operating, and what are the Indian entities' role in this particular group. That should clearly come out in this part of the TP study. The source of information again can be the annual report of the parent company. If it is a listed entity, data may be available, website of the company which could be there. Otherwise, these are the information which should go as a part of questions that we ask the assessee to give the information, what we call as TP questionnaire in a normal parlance. That can always ask this particular information to the assessee, and we should ask this information to the assessee. Agreement with the associated enterprise. This is an important document for this purposes. Also it becomes important for the next clause where we're discussing the international transaction, but agreement will bring out the relationship between your AE and the assessee. That is, what is the assessee doing for the AE? And what the agreement will also bring out, that what is the activity that Indian company will be doing for the foreign entity and what the foreign entity is into, right? And many times the agreements between related party are not seriously drafted, and that can have implication subsequently, right? Because if this is not seriously drafted, that the tax authorities, like if we give you an example, in the earlier years, no one was worried when the receivables from the related party came. And just generally everyone put 30 days the payments will be made. And we realized later on that they are giving in 6 months. But in your agreement, you had already put 30 days. And the authorities caught on to that requirement as per your terms of agreement, you are supposed to get in 30 days, but you are getting it in 6 months. Therefore, it is effectively a loan given to your AE. So these kind of things can happen. So therefore, when you're drafting the agreement between the associated enterprise, which will form part of the TP documentation, it should be taken care that it is drafted in a way which is neutral and it is balanced for both the entities. So TP agreement will be another place where this information required for reporting in this clause is readily available. That should be something which will be taken off. So this group profile, if you see, will generally remain same over years, but every year there could be some questions that we should ask. If there are any new developments which are happened in the group, restructuring happening in the group, mergers happening in the group, sell-off happening, any demergers happening in the group, or new product line, new service line, new locations which are coming up in this thing. So this is something which the subsequent years, so if you have drafted a group profile in the first year, in the subsequent years, at least to the extent of the change which has happened in the group, should be documented as a part of the profile, and last year's TP study should be updated to reflect that reality that this is the change which has happened. Because at a global level, the change might have happened, the change might have happened at the Indian taxpayer level. They might have given up a particular service line or a product profile, or they might have added something. So this is something which should be taken care when you're drafting the TP group profile. Same for the taxpayer's profile. Again, it is similar to that, and now you will be restricting more and you will be more specific to what the taxpayer is doing in India. what is the taxpayer doing in India, what is its activity, what are number of employees it is having, what kind of employees it is having, what kind of marketing team it is having. So these aspects, which are taxpayer specific, will come in the profile. Don't confuse this with the functional FAR analysis, which we'll take in the subsequent slide. But here we are looking at a broad business profile. We are looking at broad business profile. When it comes to functional analysis, we will see in the subsequent slide. But here we are only looking at the broad business profile. What is the actual business activity of the taxpayer? What is the actual business activity of the taxpayer? That should get reflected here. Again, this can be easily be sourced from the agreements, from the annual report, etc. Same like what we discussed for the group profile. Then comes the industry overview, which is a requirement under Rule 10D. Rule 10D clause C expects to give an overview of the industry in which the assessee operates. This is generally very lightly taken because you'll just do copy paste from some industry profile which is available from the website and put it here. But it can have some implications, especially if it is some specific situations. It could have implication which we should take care when we are doing the industry profile. No doubt we will give a broad overview of the industry and not specific to the assessee here. But when you are giving a profile, your position, what you are taking in the TP study, vis-a-vis industry profile, should not be conflicting. Even the industry profile, if you are giving a very rosy picture, whereas you are making substantial losses, then that can be conflicting. If you are giving general figures in the industry overview that industry, say, is charging X dollars per hour, and whereas your charge out rate is much lesser, so these could be conflicting. These were used in many of the earlier assessments where the tax authorities used the details given in the industry profile itself and then made the additions because this is given in your own industry profile, industry overview. No doubt later on the generic data was not taken into consideration by the tribunal, but this can be a situation which can arise. So therefore, when you are giving an industry overview, you need to be sure that you are being very clear and it should not be contradictory to the position you are taking in your economic analysis or benchmarking analysis. Plus specific events for the year, right? For example, geopolitical situations or economic situations, COVID-like situations, which are there, which are happening, or forex movements which are adversely affecting the assessee, or any other ban which is there. Say there could be in your assessee is into particular commodity and that export of that commodity is banned. So those aspects can come into this. Suppose you're into certain particular commodity, like there was been ban for sugar, for example, and therefore your profit gets affected because of you are not able to export because there is a government ban. So that kind of situation come. In automobile industry, certain companies were into diesel and government really, the diesel rates went up and there was a profile change which was happening where diesel vehicles were not selling. So there was a situation where these aspects can easily come into your industry profile. Geopolitical situations like what we face today. Today, if your business is majoritarily in Middle East and there is a turmoil there, and those aspects can come in the industry overview. That will help you to connect with your economic analysis and adjustments what you do in your economic analysis. And if there are those specific situations which you are taking in your benchmarking analysis or making an adjustment for a particular economic situation, it is better to connect that economic situation in the industry overview. That will help vis-a-vis when you are really going into litigation where the information is asked during the assessment proceedings. Right? Some do and don'ts in my view with respect to industry analysis is one, always try and mention the source from where the information is taken. You can always save the source. Use of diagrams and charts will help instead of lengthy text about the industry overview. Provide industry profile specific and crisp, not very lengthy. And do not try to copy paste from the earlier years or do not include industry profile which are contradictory to your TP study. You do not use technical jargons and which can complicate the industry profile, and do not document price or price trends or margins without analyzing their consequences. So in the industry overview, if you're giving a trend that in the software industry, this is the margin trend, and whereas your own margins are very low, that can go contradictory. So therefore, this is something which you have to take care. Then we come to the next requirement of reporting, that is Rule 10D 1D and international transaction. So here the expectation is what is the international transaction should be reported, right? And if it is an STT, what is the STT which should be reported, right? So international transactions, what are entered into by taxpayer into the during the year under consideration, terms of contract are required to be reported, and how the transfer price is actually determined is required to be reported. Not the ALP, how the transfer price is determined is required to be reported. So for example, what will come here is actual transaction values will naturally come here. What are the actual transactions? There will be gray areas whether this is an international transaction or not, I'll come to that. But otherwise, from a basic fundamental point of view, your actual transactions, what are actually happening. These values, what you're reporting here, should tie up with your financial statements or RPT values or tax audit values in 48.2 if you're reporting there also. So at least, I mean, I have seen cases where the tax auditor and 3CB auditors are same, but the value reported in 48.2B schedule and 3CB are different. So that creates a situation which can create trouble both for the assessee and for the person who is signing the certificates. Therefore, please tie up the values in the RPT schedule, in the 48.2 schedules, and in the 3CB what you are reporting. If you are seeing the TP notices, one of the straight questions they ask, is there any difference between RPT schedule and the TP 3CB value reported? This is the first question, one of the questions they asked in every notice. And if there is a difference, reconcile the difference and give reasons for differences. This is the first, one of the first questions comes in every standard notice which the transfer pricing officer issues. Therefore, you will have to be prepared well in advance that there is no difference. And if there is a difference, there could be a reason why there is a difference, because there might be a mistake if someone else has done a statutory auditor, he has reported wrong, there could be a difference. So there could be, these reasons will still be there and there could be differences, but there should be reasons for those differences. So therefore, actual value of transactions will have to come here. Then basis of determining price in this actual transaction. So if I'm software development service provider and I'm billing my associated enterprise at cost plus 20% or cost plus 15%, so that is my basis of pricing. So that should come here, that this is the basis, that there is an agreement, and as per the agreement that I am billing cost plus X or cost plus 15, or this is a PO and this is on the basis of which this payment has been made, or this is the service which has been received. Many times we will find that there is a gap between the transaction and very generic terms are used in terms of what the transaction is there, which can create a confusion later on. For example, they will just say services rendered, but they will never say what is the services, what is the nature of services. So what is required here again is a specific information that what is the international transaction, what is the actual nature of transaction, along with the value of transaction, So quantum and details, nature and pricing, and with which AE this has been entered into. Please give the specific associated enterprise for which the values are, transaction is entered into, not a generic statement that service is rendered so and so, but it has to be associated enterprise, nature of transaction, and value of transaction. This is the actual reporting requirement which is there under rules. Now we come to a situation where there could be doubtful whether there is an international transaction or whether this transaction should be actually reported. Many such situations will come. So if you see the initial years, there is a doubt in terms of whether if I am having a year-end receivable from my related party, whether I should report it as an international transaction. If I am doing an issue of shares, whether I should report it as an international transaction. Whether if there is a write-off or write-back of some transaction or some notional adjustment, whether these are actually reportable transactions, right? Now, given the fact that non-reporting leads to severe consequences both in terms of penalty and reopening of assessments or such things, many times we will try and be a conservative in terms of report what is the, at least report, when in doubt report, right? So now question comes is how do you handle these kind of a transaction? Suppose I have a sale and there is a receivable. Should I report both the transaction or report only the sale transaction, and receivable is not something which is there? Now if you see the thought process in the initial years, they said receivable is not a separate from sales. Receivable emanates from sale. Because there is a sale, there is a receivable. If there was no sale, there is no receivable, right? And therefore, receivable is not a separate transaction from sale, and therefore, if you have reported sale, then receivable is not required. Then we have a 2012, then amendment was made to the definition of international transaction, where they had added an explanation to 92B. Explanation 1 was added, where they tried and said receivable is a separate transaction. Receivable is an international transaction, not separate transaction. Receivable is an international transaction. Then the court's thought process, if you see in the subsequent years, the courts have taken a view, for example, Delhi tribunals in Orange case, then Emery Press case. They said if your receivables are substantially over your agreement date, in those cases it forms a separate transaction and it is separately benchmarked also. Right? We'll come to benchmarking a little later, but what I'm trying to say that if there is such kind of a situations where your entire 12 months receivable are outstanding, then it is a fit case to report that receivable also. Why? Because the assessee is giving that benefit to AE and giving the receivable there to the AE, and AE is able to use that funds. Where the receivables are coming in the periods prescribed as per the agreement, there may not be really any challenge as such of reporting it separately. In a case of the similar situations will arise, for example, in case of issue of shares. When I'm doing issue of shares, technically transfer pricing itself is not applicable because it's a capital account transaction. Whether you issue on discount or premium or anything, you really do not have to benchmark the ALP of that issue of shares, which is a settled case because of Vodafone's decision and Shell's decision. And then the board also clarified that for this transaction, ALP determination is not required. But the question comes is, should I report this transaction? Now, if you see the 3SEBI, there is a specific reporting requirement for issue of shares, right? There is a specific line item for issue of shares. Now, if you try to reconcile this situation, if you try to reconcile that one way, there is a definition which specifically says that these are international transactions, and at the second place, there is no ALP benchmarking requirement for this. So, the way to reconcile this, no doubt these are conflicting positions. The way to reconcile this is, if you look at the language and try to reconcile and reporting requirement. So, if I issue a share to my related party, is it an international transaction? Answer will be yes, it is an international transaction, right? But should I compute the ALP? Answer is no, because you are issuing a share, you are getting a money, there is no really any income which is arising from that international transaction to TP to be applicable. So, to the extent it comes for reporting purposes, these kind of transactions may be reported because ultimately they still fall within the definition or within the meaning of the term international transaction under section 92B1. But when it comes to computation of these kind of transactions, like dividend given, like loan taken or loan repaid, there can never be an ALP for this. There can be an ALP for interest on ECB loan, but there cannot be ALP for how much loan you take or how much dividend you pay. Right? So, in terms of reporting, they may qualify as an international transaction, but in terms of computation, there is no requirement to compute ALP for these particular kind of transactions, So, there will be these gray areas which will come into picture. There will be these gray areas which will come into picture when you are reporting international transactions either under the TP study or TP certificate, and conscious call in terms of both weighing the risk and penalty risk as well as non-reporting risk should be taken into consideration, and accordingly a call should be taken. Then we come to the second leg. Now we have seen the we have seen the entity level information, transaction level information. We've seen the international transaction. Then we come to the functional analysis, and then we come to the benchmarking part of it. Now, why functional analysis is important? Why this is the highest amount of importance is given to functional analysis in the entire TP study or TP documentation. This is for the simple reason that if you see fundamentally, what does 92F or what does the TP is all about? And is that you benchmark or you enter into a transaction what at the same way you would have done it with an independent party, right? I have to do a transaction with my related party in the same way what would have done with an independent party in an uncontrolled situation, a similar transaction in an uncontrolled situation. Now, to bring out that aspects, that what is a transaction really, the functional analysis is the key. Without functional analysis, you will not be able to characterize what the Indian entity is doing, what are its transactions, and how they should be benchmarked. So, here is the basis where you will really put forward your thought process or your articulation that why a particular transaction is entered in a particular way. Given that this is also a requirement of the rules itself, this has to clearly come into picture. And every person, if in an independent person, the idea of he is entering into a transaction is he makes a fair profit of his transaction. Profit maximization and fair and equitable profit is made out of a transaction. The TP regulation itself are about fair and equitable allocation of profits. So keeping that economic theory in mind, the functional analysis requirement comes under various clauses, Rule 10D 1D, Rule 10D 1E, and Rule 10D 1F. So this is something which we have to bring out in the report. What are the different aspects of functional analysis? One is contractual terms, second functions performed, risks undertaken, and assets employed. So these are the 4 pillars of the functional analysis from the Indian transfer pricing standpoint of view. That these are the 4 aspects which has to come into picture. Contractual terms, so agreement with your associated enterprise, and what are the important contractual terms in that agreement. This is what will form part of the this particular first line of reporting. We are not expected to copy paste the entire agreement, but report what is the crux of that agreement. You have to summarize or try and bring the crux of the agreement into this particular thing. This again will help you to link it to the benchmarking analysis or economic analysis, what we call. For example, if you want to adopt a cup method subsequently in your TP study because there are internal comparables, for example, then in that case, the terms of contract which you are reporting here will have to match with the terms of contract which are for the external parties. Then only both will become comparable, right? So if your transaction is at FOB value, or if your transaction is at CIF value, or how the term payment credit, the credit terms are there for the transactions, what are the terms of payment, what are the warranty which is there as a part of your transactions, these all have to be brought out clearly in the contractual terms which should be reported as a part of functional analysis. This is a requirement of law. And these functions which the Indian company is doing, we have some tables, I will show you that, but otherwise the broad idea here is to give the overview of what are the functions that Indian company is doing. For example, Indian company may just be doing trading activity, and in trading it may be taking no risk, it may be a low risk distributor. If that be the fact pattern, that functional analysis should, FAR should really bring out clearly that this is the facts of this particular case, and the Indian entity is only doing distributor. So if you see the OECD or UN commentary on this, especially the UN commentary, they give an example of IP holder. So if there are 3 companies in the group, one is manufacturer, one is the R&D, and one is the distributor, right? Who holds the IP should clearly come out, right? That if the R&D holder may just be a contract service provider, and he may not be really the owner of an IP. The owner of IP may be manufacturer. Or the R&D developer may be owner of the IP also, but he might have license to the manufacturer. So if whatever are the fact patterns in a particular case, in terms of what are the functions performed, have to be brought out in this particular requirement. Then risks undertaken, because risk is fundamental to any business, and who has the capacity to take the risk, those aspects will have to be clearly brought out into this part of the TP documentation. Assets employed, tangible and intangible assets. Tangible assets is easy to get it from the financial reporting, but there could be a lot of intangible assets which are not get captured in the financial statements. A statement on that, whether who is the owner of intangible assets, should be brought out in the TP documentation. Now, if this FAR analysis, what you're doing here, will naturally have to compare with the FAR analysis of the comparables, because FAR analysis of the assessee and FAR analysis of the comparables, it is very difficult to do FAR analysis of the comparables, but at least a broad outline of the FAR of the comparables will also have to be done, right? So this both is what needs to be compared to be really a comparable under Rule 10B. If these two are not comparable, then you can't really compare them. For example, if you are a wholesaler, your FAR is of a wholesale distributor, and you are comparing with a retail supermarket chain, then they both are incomparable because the FAR is different. So you'll have to bring out that particular aspect very clearly into your functional analysis, that what is your FAR? Are you a wholesaler or you a retailer? What kind of manufacturer are you? What kind of a service provider are you? High-end service provider or low-end service provider? These aspects will have to be broadly brought into functional analysis. Plus, additional point that has to be taken care is where you have entered into multiple transactions. Many times you will enter into multiple transactions with the group, right? Now, how are these transactions either linked or they are independent transactions? If you take a famous example of printer and cartridge, they sell the printer at a lesser price and then recover the money in a cartridge. Right? Similarly, razor and blade, they say. You sell the razor at a lesser price and then recover the money in a blade. That could be with the car manufacturers, because you'll sell the parts or a car initially at a loss, but then you make money in the service transactions, post-sale service transactions. So this way, there could be unique features of a business model. The transactions may appear independent, but they're really linked. They are connected to each other, because the profitability, you may make a loss in one, but you may make a profitability in something else. That happens with many companies. That happens in many business models, because the initial transaction, suppose you are a service transaction of doing an R&D, you may do it at a loss, because you know the subsequent manufacturing order will also come to you, because you have given a prototype, first prototype you have given at a loss, but subsequently when the manufacturing really happens, it will come to you. So there could be these kind of situations which are unique to an assessee, and that uniqueness, if it is there, and that should be brought out as a part of FAR analysis, without going into too much into bringing out confidential information, but to the same extent trying to bring out what is the relevant part in the functional analysis. So this is something which has to be taken care. From where you can get the information of functional analysis, one is the transfer pricing questionnaire and management reply, business process diagrams or flow charts of the organization chart, annual report, contracts and other supporting documents related to international transaction, then documents related to internal control, documents which are filed with other authorities sometimes can bring out this information, previous year transfer pricing studies, TP documentation, or transfer pricing orders or other assessment or orders of the other authorities. So this is a broad area where you can possibly find the information about the FAR, contractual terms, about the functional analysis. And the first part becomes critical, transfer pricing questionnaire and management reply. This is something which, if you're doing the TP study for the first time, for a client, if you're doing a TP study for the first time, this is something which you should seriously take. No doubt in the subsequent years, you need not repeat the entire transaction, but if you're doing it in the first year for a client, then the transfer pricing questionnaire, trying to detailing the entire FAR of the client is something which should be part of your analysis, No doubt in the subsequent years, the first year analysis can be replicated with changes which may happen in that particular year, but this is something which should be seriously done when you're doing the TP study for the first time. I'm given just some example here that what a broad, it's just a tabular thing, but given that TP studies are being done from last 2 decades, many of you would have also done in your regular thing, you would have seen these kind of tables. You'll have to see in a respective case what kind of functions are performed. So if you take a simple software development entity, which is many TP studies all of us will do because Bangalore being the IT hub, right? What are the basic things that we should take care? I've tried to put it in a chart, but if you fundamentally look, what are the basic things that you'll see? One, what is the AE business into? Is the AE also, that means suppose it's a US parent and Indian subsidiary. What is the US parent into? First question, whether it is developing a product, off-the-shelf product or a standard product, or it is also a service provider who is taking a service contract from a third party and then offloading the service to Indian. So you have seen many captives in Bangalore also or India also. One set of captives will be where the US company has taken just US is a marketing office. There are promoters who would have been from India, would have gone there, set up the companies and who have wherewithal to get business. And they're getting that business, but to cut the cost, location saving, they offload the work to the Indian entity, right? So there is just a service to service contract, right? But it could be sometimes higher end where the US entity or UK entity or German entity, whatever it could be, it is really doing a new development, new R&D activity, right? And it could be having its own product which is sold to third parties. Or the software which the Indian entity is doing may just get embedded in the hardware which the US company is doing. So if there is a company like, many companies like AMD, Intel or Toshiba, so many companies, which the Indian entity's software gets embedded into hardware which is ultimately sold to the end customer. So then there is a particular cycle or chain which we have to, supply chain which we have to bring out that facts, that what is this Indian entity doing, what is a foreign entity doing. So suppose the foreign entity is into printer business and it is making printer and selling to the end customer, but the Indian entity may just be doing software which goes into that printer. It may really not be doing the printer manufacturing as such. It may just be doing the software that is going into that printer. So my characterization of Indian entity still remains that software developer. So if I do a FAR for such kind of entity, I am going to say the US entity is into manufacturing of the products. It is conceptualizing the actual end products. And then it is giving that what are the software requirements to the Indian entity, and Indian entity is then doing whatever is required, custom development, coding, documentation, testing, etc. for that printer, right? So this is one aspect which can be brought out very clearly in your TP studies. What are the different functions that Indian entity is doing? It could be doing software development, coding, documentation. Now the things have changed. A lot of this is also automated. But whatever it is, that has to be brought out. Testing activity, whether it is done. So this is something which can be taken care in part of TP study. And if it is a cost plus entity, you can bring out that aspect also into your FAR analysis, that this is just a cost plus entity and the cost plus benchmarking is done. Now similarly, if it's a trading entity, what will happen is the company outside India may be manufacturing the particular part, and then it may be selling that part to the Indian entity. Indian entity may be selling, just buying that part and selling the part to the end customers in India. So the role of Indian entity is just to do marketing and inventory management, because it has to do inventory management and marketing. The role of foreign company which is doing actual manufacturing is the part development, understanding the part requirements of the end customers, having the manufacturing, whatever logistics required for the manufacturing, and then selling, shipping that part to the India. So India will have the inventory management and end customer sales, which marketing and end customer sales is what India will be doing. So it will be doing price negotiation with the end customers, and the FAR here will have to bring out that Indian entity is doing only trading activity and it is not doing any value addition to the parts purchased. Now why this is important? Because if you are not doing any value addition and your FAR characterization brings out the part that you are not doing any value addition, then you have to be careful that you are selecting resale price method. That is connected there. But if you are doing value addition here, then if you are bringing out in the FAR that there is a value addition which is done by the Indian entity level and then select resale price method at the end in the economic analysis, it will become conflicting. So therefore, this FAR, where you bring out this characterization very clearly, that I may say a captive service provider, then a particular method may automatically become available. If I am just a trader without any value addition, then I may take it to being a resale price method. So this has to be brought out here so that you can later on connect this to your comparative analysis, economic analysis. So this is what I was trying to drive, that this part should bring out the Indian characterization very clearly. Similarly, for risks, you'll have to say that what are the risks the Indian entity is bearing. Generally, if it is a cost plus entity, Indian entity may not be bearing any risk, except maybe to some extent to a single customer risk. But otherwise, the Indian entity, because all its costs are billed. Now, if all the costs are billed, including the idle cost or whatever costs are required, then the Indian entity, if it will become generally a risk-free entity or risk-mitigated entity, whatever term you want to use. So if your business model, if it is a cost-plus business model as per the terms of agreement, so you start with the terms of agreement, you bring the characterization there that the terms of billing is cost-plus. Then in the software development, you will say that this is the activity, and in the risk part, you will say that, look, because I am a cost-plus, my all costs are taken care, all costs are taken care, whether it's an idle cost. So I may have an employee who may not be working for 6 months, but his cost is still I am going to bill as a part of cost plus model, right? So therefore, my cost of idle capacity is not there. Similarly, I may do error. I may have done wrong coding or wrong service, but still whatever I have to do to rectify that service still gets billed in a cost plus model. So therefore, my cost of doing service liability risk may not be there. Right? So this gets connected to your contractual terms. So contractual terms bring out the fact that you are cost plus entity. The FAR functions will bring out the fact that what service you are rendering. The risks will bring out and connect it back to both of them and really bring out that what are your risks. So in a way, there is a thread connecting all of these. In a way, there is a thread which is connecting all of this. And the last part of this is the assets. As I said, you'll have to bring out whether what assets are used, whether the assets are leased assets, tangible assets, intangible assets, whether there is your owner of any intangible or who is the owner of intangible, who is the owner of brand in a trading activity, that could be very relevant. In a manufacturing activity, that could be very relevant, that who is the owner of the intangible assets. And I have got only a license to manufacture that. I've got a technical know-how from my AE to manufacture the products. So this comes in the assets. These parts should be brought out in the assets. These parts should, so these four aspects form the functional analysis, FAR analysis, which we need to do. Then we try and see the economic analysis. And this is again the critical part, because this is the numbers. Whatever I say in functional analysis ultimately has to be translated into a computation. I may say in functional analysis that I have a idle capacity risk, because though I have installed capacity of 100%, what I am utilizing is 20%. Ultimately, I need to translate that 80% underutilization into a number when I do the economic analysis. Unless I am able to translate that into a number, it really doesn't help. So you have to sync all of this. Now, what are the main parts of economic analysis or comparatively analysis? One is the selection of most appropriate method. Which method is selected, why it is selected, and why other methods are not selected, right? That comes in the selection of most appropriate method. Rule 10C gives us the benchmark for selecting the most appropriate method. That gives us the parameters, how are you going to select the next method, the most appropriate method. That we'll see in the next slides. But there can only be one most appropriate method. There cannot be more than one most appropriate method. There has to be one most appropriate method. And this most appropriate method, given that you also select in form 3CB. So the method selected in form 3CB and TP study should be in sync. Many times there have been cases we have seen where method stated in 3CB is incorrect, whereas when you really go and do the TP study, you realize the method stated in 3CB doesn't work in the real life. So you have to ensure that the method in 3CB and in the TP documentation is same. So selection of most appropriate method. Selection of tested party. This is an important concept. Why it is an important concept is, who is a tested party? Tested party is the party whose price or margin is being tested. Whose price or margin is being tested. See, there are two parties to the transaction, right? Who are the two parties to the transaction? Indian party and the foreign AE. It could be foreign parent company or foreign subsidiary, right? It could be anything. So there are two parties to the transaction. Can you benchmark, or should you only benchmark the computation of arm's length price only with respect to Indian party, or can you go and take the foreign party also as tested party? You got the point? Say for example, India is selling a manufacturer, it's manufacturing a pen and selling it to its parent company outside India, right? It is selling at 100 rupees, for example. But my foreign parent is also purchasing a same pen from another manufacturer in India at say 110 rupees. Suppose there is a same, assuming all parameters are matched. Now, should I benchmark this transaction only looking at Indian entity, or should I also look that, look, your foreign parent has also purchased from third party. It has purchased from third party at a higher price. That means the Indian party sold at a lower price. And is this price lower getting influenced because of the associated enterprise relationship, or are there differentiating factors? Right? Now, so therefore, in this example, the tested party will be foreign parent, foreign AE. That will be the tested party, assuming you have data. Now, if you don't have data that data is purchased from third parties in India, then there is a different issue. But assuming you have this data, what we call as a tested party will be the foreign parent or foreign associated enterprise, foreign AE. So this is the concept of tested party. So you have taken the foreign AE as tested party in this example, and you are testing the purchase price from India, from related party and from unrelated party. And in that testing, you can say in the hands of Indian party, assuming all parameters were same, India sold at 10 rupees lower to the foreign AE, which is a reason for benchmarking. But suppose you are able to then explain the reason for this 10 rupees difference. You could say that I got cash, I got advance, he got 6 months credit. So that could be a reason for difference. So there could be such differences, but unless you document those differences, it is not going to come out. So that is a part of economic analysis. So selection of tested party, selection of comparables. It could be internal comparables, it could be external comparables. I'll give some examples as we proceed further. So there could be internal comparables which are emanating from the organization itself, or external comparable either in public domain or from the databases, whatever databases we use for transfer pricing. So that is called external comparables. Then computation of the price or margin of the comparables, that is the next part of the economic analysis. And adjustments, computation of arm's length price, computation of margin of the comparables, margin of the taxpayer, what are the price which the taxpayer has paid or the price which the comparables are paying, that will come here. Adjustments, if any, that means whether any adjustments are to be made for differences. So if you look at adjustments, there are two types of differences. There are two types of differences, Rule 10b3. Rule 10b3 says, and read with Rule 10b2, it clearly provides that the differences could be in the enterprises which are entering into a transaction, or difference in the transaction itself. Difference in the enterprises which are entering into a transaction, or difference in the transaction itself. The difference in the transaction, has I given an example of credit period. That is the difference in the transaction. One transaction is cash and one transaction is 6 months credit period. Naturally, there will be some influence of price because of the extra credit period, right? So this difference is a transaction specific difference. This is difference is the transaction specific difference. Enterprise-wide difference could be because of size, could be because of market, could be because of various other dynamics. Now there could be both of these differences. The Rule 10b3 says whether the comparable, are there any differences between the comparables entering into a transaction or the transaction itself, and whether that difference has a material effect on the price or margin. Is the difference such that it has a material effect on the price or margin? If the answer is yes, then the next question is, can you make an adjustment for that difference? If you cannot make an adjustment for difference, reject the comparable. If you can make an adjustment for comparable, for the difference, then take it as a comparable. So this is the mandate of Rule 10b3. So if I gave the same example, that I am saying that there is a 6 months credit period, and in its first transaction there is no credit period, then question is, can I make an adjustment for 6 months credit period? Possible, because I may have a easily available data that what would be the normal interest rate for this kind of a credit period, right? So then I can bring out that 110, give a discount for the credit period and come to the arm's length price. There could be similar such examples. Suppose one transaction in FOB transaction, free on board, other transaction is CIF transaction, inclusive of insurance and freight. Can I compare it straightforward? No, because there is difference. Right? There is a difference of insurance and freight in one pricing, whereas there is no difference. Now from CIF, can I remove insurance and freight and bring it to FOB? So there is a difference. Can I remove it? Do I have data to reliably remove that IF component and bring it to FOB component? If answer is yes, then remove that and compare. If answer is no, reject it. So that is the mandate of Rule 10b3, and that is what you will have to bring out. So if there are any differences between the transactions, and whether any adjustment is required for that differences, whether reliable data is available for the differences, and whether you have made such an adjustment, right? So these are the points which have to be taken. This is the extract of the rules. I'll just go to the, yeah. Now we'll see some examples applying some methods so that it becomes more easy for us to understand what we have discussed in theory. So as I say, the genesis of computation of ALP comes from 92C1. 92C1 mandates that you select a most appropriate method and compute the ALP. So 92, if you start from 92, 92 says income arising from international transactions shall be computed having regard to arm's length price. And that computation of arm's length price comes in 92C, right? And then we go to the Rule 10b. Broadly, 3 broad classifications of methods. First is traditional method, what we call CUP method, comparable uncontrolled price method, resale price method, cost plus method. PSM, TNNM, and sixth method, Rule 10AB method. Just to have a broad fundamentals of this, the first method compares price, comparable uncontrolled price. So whenever you have data on price and you are clear that data on price is available, then can you select a cup method should be the point of view that you should look at it. If you do not have data on price, you'll have to straight away discard cup method. There is no other way around it. Cup method is the most direct and most reliable method, but getting the data on price is the most difficult part of it because that is not available in the public domain. Next method, RPM and CPM, these two compare gross profits. And next two methods, PSM and TNNM, they compare net margins. So you move from price, gross margin to net margin. So there are three different ways to compare in the transfer pricing. One price, one gross margin, and net margin. One method looks at price, two methods look at gross margin, two methods look at price. The last residual method, which is Rule 10AB, this is more of a hypothetical method. For example, today you want to take, say, a loan. Suppose Indian subsidiary wants to take a loan. It approaches a bank in India or bank in foreign country and also asks its AE that give me a loan. The Indian banks gives a quotation that I will charge you SOFR plus 5%, but my foreign AE is giving me at SOFR plus 3%. Now I've got a quotation. Can I take a quotation as a comparable? Can I take a quotation as a comparable? Now I can say that look, my AE, when I really wanted to borrow, I went to an independent party, and that independent party gave me a higher rate. That's why I took it from AE. What is wrong in that, right? So that doesn't get covered in the first 5 methods because first 5 methods expect an actual transaction. Whereas the last method, Rule 10AB, there could be a hypothetical transaction also. It could be a transaction which has been actually entered or which could have been entered, So quotations, market survey, market rates. Suppose many times you want to compare the commodity rates on stock exchanges like London Commodity Exchange or somewhere else. Right? For metal exchanges we can compare, or sugar and other parts, or cotton we can compare. So there are these rates which are available in public domain. They are reflective of actual transaction, but they are actually not an actual transaction. So for these kind of situations, you should select the Rule 10AB. In your 3CB, for these kind of transactions, Rule 10AB is what you should select. And those are permitted under Rule 10AB. Those are not permitted under any of the 5 methods. That is why Rule 10AB was subsequently inserted, and it's a valid quotations can form part of here. And this could also be used as an advice to clients that get these quotations or benchmarking when you're actually entering into a transaction. That way you can strengthen the documentation for related party transactions or creating a benchmarking within the group itself if the external data is not available, right? So this is on the broad understanding of methods. Now if you see the cup method, before going to cup method, Rule 10C2 basically says that you'll have to determine has may prescribed, and prescribed is in Rule 10B. Okay. I'll come to this provision at the end when you're discussing the range concept. Okay. Come to Rule 10C. How do you select the most appropriate method? As I said, we have 5 methods and the 6th method, right? Out of 6 methods, I have to select one method in my Form 3CB, and it should be the same method which is there in the TP study. Now, while selecting this method, Rule 10C gives me parameters, gives us the parameter that how do you select the most appropriate method. Now what parameters are given? Nature and class of international transaction. Nature and class of international transactions. That means what is the international transaction? Suppose the international transaction is a trading transaction, right? Then straight away CPM and PSM may not be applicable because they are applicable to specific facts. So the 5 methods, each of the method is applicable to a specific fact. First method, price, it is universal. You can apply to any damn transaction if you have data on price. Second method, resale price method, has the name suggest resale. If you buy from AE and sell to third party, you are doing a resale. Then it is applicable. But if you sell to your related party, this method is not applicable. Keep this in mind. Only applicable when you are the reseller. That is, the tested party is the reseller. The tested party should be reseller. And only then RPM is applicable. if you buy from India and sell to your related party outside India, then RPM is not applicable. But when you buy from related party and sell to third party customers in India, then RPM is applicable, assuming India is a tested party. Or you'll have to flip and take the AE as tested party. Then it's a different situation. But otherwise, in a general situation, the tested party should be reseller, then without value addition. So if you get a pure distributor transaction or trading transaction, first thing that should come in your mind is, can I select resale price method as a comparable? Because this looks at gross margin, sales minus COGS, and cost related to purchases. These are the fundamental three components of resale price method. CPM, again the name suggests costs plus. That means the tested party has incurred the cost and there is getting a plus on its cost. It is getting a plus on its cost. Cost incurred plus. So when I render service and I get a cost plus, when I render a service, when I get a margin on my cost, then CPM is applicable. No doubt CPM doesn't take into consideration all the costs, it only takes into consideration direct and indirect cost, and it doesn't consider the SGM, sales and general marketing cost, that goes into TNM. But cost plus has a fundamental, it is an outward for you, that is the tested party is rendering services or selling the manufactured goods, then it will be applicable. It will not be applicable in other circumstances. So if you buy a raw material, manufacture and sell to Indian customers, CPM cannot be applied, right? Then a PSM. The PSM is a profit split method. So the associated enterprises are working in such integrated manner that you cannot really identify who is doing what or where intangibles are involved. Only in that limited circumstances, the PSM can be applied. TNM other is more universal in nature. You can apply to different kind of transactions TNM, and rule 10AB I already explained. It's more a quotation or more a different kind of a method where you can take into consideration. So nature of international transaction, depending on what is your international transaction, you have to select most appropriate method. So if I'm doing a trading transaction, only two methods which I can consider, three methods I can consider is price, if I have a pricing data. If I do not have pricing data, then RPM or TNM. This is what I can consider. Two methods are straight away discarded. Then class of AE, taking into consideration FAR, functions performed, assets employed, risks assumed. So class of AE is that, again, the characterization of AE, what we discussed when we discussed the FAR. Availability of data, coverage of data, reliability of data. So if I want to select RPM, the data expected is at the gross profit level, right? Now, to select RPM, no doubt it is a distributor, but can I select RPM? I cannot select RPM if I do not have a gross margin data. Suppose the financial reports, if you see our financial statements, sometimes it is very difficult to calculate GP, right? Because the net margin is only given, gross margin is not given in our financial statements, the way we are reporting under the company law. There could be possibilities that all the four components for calculating the GP may be available, opening stock, closing stock, purchase and sales. But there could also be a situation that in the public domain annual report, these details may not be available, right? So availability, coverage and reliability of data, right? So if this is a parameter, now I have a trading transaction, but I do not have a GP data, then I have to reject RPM. Then I have to move to next method, TNM, and see whether I can apply the TNM. So this is the third point, availability, coverage and reliability of data. Degree of comparability existing between a transactions being compared. Now, suppose if you take the same trading transaction, I am buying, say, toasters from my related party and selling in the Indian market, right? And making, say, 10% gross margin. I buy at 100 and sell it at 110, right? I have a comparable data which is not on toasters but on blenders. Can I compare? Is it permissible? Yeah. Can you compare this? This is a standard example. It's a very old example given in OECD. Toaster and blender example. Now, depending on the method, if you want to compare a price, you naturally cannot compare a price of a toaster and blender. Leave alone toaster and blender, even a different category of toaster you cannot compare, right? But when I compare margin, gross margin or net margin, there is a dilution which happens. If I want to compare gross margin, the question is, I don't look at exact product comparability. I look at function. What is the effort involved in buying a toaster and selling a toaster, and what is the effort involved in buying a blender and selling a blender? If the efforts involved or the functions, FAR is same, then though the product may be different, the margin will be broadly similar, right? So if you for a same effort, if you are getting 10% gross margin, for a selling blender, you will not get 50% gross margin. That is ruled out, right? So it is a similar product category. It is a similar product category. No doubt, if the product category is completely different, then it may be a different situation. But if it is a similar product category, falling in a broad range of products, then there may not be much variation in the gross margin and net margin of the same industry segment, in the same industry segment. So those cases, the gross margins may still be comparable. Suppose I am comparing a single bed mattress versus a double bed mattress. The margins may still be same. The price may be different. The efforts involved in terms of logistics, buying, storage, then convincing a customer to buy it, so that may still be same. So that is why when we say degree of comparability depends on the method. So if you have a very high level of degree of comparability is required for cup method, because price, smallest difference will impact the price. A brand, unbranded, packed, unpacked, even if it is unpacked, packed in a black color and packed in a colorful color, the rate may be different because there is a perception of a better color gets a better price, right? So those aspects will impact the price, but those aspects may not impact the margin, because if I have to pack it better, I have to also have a better packaging quality. So there is an expense also incurred. Where the revenue is increased, the expense is also increased. I'll give one more example. Warranty. Can you compare a price with warranty and without warranty? Naturally very difficult, right? Because if I sell a laptop with 1 year warranty and without warranty, unless I can exactly quantify the price difference for warranty, then fine, I can compare, remove the warranty cost and then compare. But if I'm not able to do that, then the question is can I compare gross margin with warranty, without warranty? Again difficult, because in the gross margin, the sales will be including warranty, but the warranty cost is below gross margin, right? So the person who has sold with warranty, his gross margin will be higher because he has to incur higher, lower the line, below the line item expenses. But can I compare net margin? Possibly yes, because extra warranty cost fetched me extra sales price relating to similar net margins. So this way, depending on what are the parameters of comparability, what is the data available, one will have to say degree of comparability which is there. And last item is the extent of adjustment. Again, if you see the extent to which, not this, extent of which accurate adjustments can be made for an account of differences. That means, if now we were discussing an example of FOB and CIF, right? Now I have to remove CIF to bring it to FOB. I have to remove IF to bring it to FOB. The question is, do I have this data? Suppose I don't have this data, but can I assume that for this kind of a shipment, this is the industry standard insurance cost of 1% or freight cost of 2%. Assuming that data is available, am I making a reliable assumption? Now I'm making an assumption that insurance cost may be 1% only, right? So I'm making an assumption. So is my assumption reliable? If my assumption is reliable, still I can do it. So this is how these rules are being framed. These are all international, basis on the international standards only. It is not something which is unique to India. And this way you'll have to quantitatively apply and make an adjustment. So based on that, you can still take it as a comparable. Nature and extent of reliability of assumptions, the same thing. Yeah, what assumptions I am making. We have another 10-12 minutes. We'll try and just take some important points from the methods, because we have around 12-15 minutes more. Now, if you see cup method, as I said, the fundamental point of a cup method is the pricing, the data on pricing, right? Now, if the data on pricing and product comparability, the parameters for a cup method is the pricing data, comparability, similar product. You can't go for different product lines here. You'll have to have a comparable which is exact comparable, very similar product. And difference. If these are the three pillars of a cup method. Now cup can be internal cup or external cup. You can get data internally where you are buying from third party and buying from AE, or it could be external cup, right? It could be both internal or external. The starting point here is the price which is paid in the third party transaction. The starting point as per rule 10B1A. You start from the price paid in an independent transaction, and from independent transaction come to the related party transaction. So as I gave an example of a pen, I have sold at my AE at 100 and I have sold to third parties at 110. I got 10 rupees more in third party transaction. So I start from 110. The next question I ask, is there a difference between these two? Now there could be a difference, quantity difference. I've given bulk to my AE. I do not have marketing effort in my AE sales because I get orders regularly, whereas for third parties I have a marketing team of 5 people who is going and doing the marketing activity, right? So these could be differences. So list down the differences and then translate that difference into adjustment to bring out 110 to either lower or upper. It could be upper also because in AE you have given credit period of 6 months and 110 is a cash payment. So 110 can actually go up further, right? So start with the third party price, find out the difference, both in terms of transaction difference or enterprise wide difference, and make an adjustment for difference, and then arrive at the arm's length price. Compare that arm's length price with the transaction value. Suppose I make an adjustment, suppose there's only difference of credit period. Let's assume 5 rupees is the adjustment for credit period. So I sold at 110, credit period is 5 rupees, so I come at 105. But my transaction value is 100. So now there is a difference of 5, right? Now if this difference is what is TP adjustment, this difference is what is TP adjustment. You should have actually sold at 105, but you have sold at 100, right? So this is what comes out in the adjustment at 5 rupees. There is an arm's length range concept. I'll come to that. I'll spend a couple of minutes on that also. But fundamentally, this is how the cup method works. Then we go to resale price method. In the resale price method, the starting point is the sale you are making. You are writing a sale. So the resale will be applicable when you are purchasing from related party and selling to third party, correct? You are purchasing from related party and selling to third party. Now I have purchased, say for example, from my related party at 70 and sold at 100. So this is my transaction, simple transaction. So my starting point is the sale price which I made to third party. See, if you look at fundamentally the TP, the starting point is always an independent transaction, right? In a independent uncontrolled transaction is starting point. That is the starting point always in any of the methods. That is the fundamental of TP. So my starting point is the third party sale price, which is 100 in the example below. The question is, I have made 30% gross margin. Is this 30% gross margin sufficient? If the 30% gross margin is not sufficient, suppose there is a comparable transaction which I have given a first example just for the name's sake that the gross margin should have been actually 40%. When my gross margin is 40, then how much should have been my purchase price? 100 minus 40% on sales. 40, so my purchase price should have been 60. But I have purchased at 70. So 10 rupees becomes your TP adjustment. So you start from third party sale price, reduce the actual gross margin, what an independent party would have earned, and then you come at the purchase price. So you start from the credit side of P&L, reduce the GP and arrive at the purchase price. Because the transaction, international transaction is the purchase with the related party. International transaction is the purchase with the related party. That is on the RPM. There's one more leg to RPM, that if there are any expenses incurred for purchase of goods, that also has to be reduced. So whatever the actual expenses has to be reduced. CPM works the other way around. When is the CPM applicable? When it's an outward transaction. That means the tested party is rendering services or manufacturing and selling goods, right? It's an outward transaction. RPM is that you purchase and sell. Whereas here the sale is to related party. So in the sale to related party, your cost is uncontrolled, right? In a sale to related party, your cost is uncontrolled. So you start from cost. So direct cost, and they have basically in TP classified the cost into 3 broad baskets. Direct cost, it could be direct cost of say manufacturing goods like raw material cost, etc., etc. It could be indirect cost, allocable overheads, etc. Or other costs like sales and general administration cost. In CPM, we take only direct and indirect costs. That's why we are comparing gross margins. We are not comparing advertisement cost, sales and marketing cost, general administration cost. Those costs are not considered for the purpose of CPM. So what I do is I take out my direct cost. Suppose I have sold a product worth 10 crore rupees to my AE. So what is direct cost of manufacturing this product? What is indirect cost manufacturing of this product? That becomes my starting point, direct and indirect cost. I have to load a markup on this, what an independent party earns a markup. So if I'm able to find out what an independent party earns a markup on this, then I load that markup on this cost and you get the sales price. It's as simple as that. Cost plus a margin, cost plus independent party's margin, get a sale price. Direct cost, indirect cost, margin of third parties, you get the sale price. So this is CPM. This is CPM. There could be a lot of complications, but given the time limitation, I'm just giving a broad outline of this. But this is something in a simple way to understand that this is how the CPM works. PCM is more complicated. PCM looks at consolidated profit. It is more inward method, which looks at the consolidated profit. That means what profit. Now there are two parties to transactions, say I and my AE. You consolidate the financials of assessee and AE. You consolidate the financials of assessee and AE, and what is the consolidated profit has been earned by these two parties, and what is the contribution of each party. Suppose A and B. A is in India, B is outside India. Both are doing an activity together. And you have to find out what is the contribution made by A and B to earn that consolidated profit. And that consolidated profit gets splits into A and B. For this, a lot of internal data is required for doing the benchmarking. A very objective FAR analysis is required. All that stuff will be required basically to do this. TNNM. This is most widely used method. If you see most of the TP orders, it is more easy for them to apply TNNM. One of the simple reasons being the financial statements, it is more easy to calculate net profit compared to gross profit, the way we report financial statements. Given that data on price is very not easily available, therefore the TNNM becomes the choice or a method of by default in many of the cases. Now TNNM is also a flexible method in terms of what you want to do with the TNNM, because it gives a lot of leverage. You can take margin on cost, margin on sales. Suppose you are selling to related party, you can take margin on cost. If you are buying from related party, you can take margin on sales. Suppose you are a manufacturer, you buy raw material from related party, do value addition and sell to third parties. So margin, your net margin or operating margin on sales is what can be taken as a part of TNNM. Here you will consider all the costs. Here you will consider all the costs which are part of your P&L for calculating the operating margin. We'll just spend 2-3 minutes on resale the margin range concept, and then if you have any questions we can take. There are two range concepts which are given in the TP regulations, Indian TP regulations. If you have 6 or more comparables, then the concept of interquartile range and median applicable. And if you have less than that, the concept of arithmetic mean, simple arithmetic mean is applicable. If you are taking simple arithmetic mean, then the range is 3% in normal cases, 1% in case of a wholesale distributor. They have defined wholesale distributor whose COGS is more than 90% of sales and his inventory rotation is less than 10%. I mean, he has basically rotated 10 times his inventory, right? Inventory holding is less than 10% of sales. So if these two conditions are satisfied, the person becomes an wholesale distributor or wholesale trader. For him, the arm's length range is 1%. 1% do not understand it as absolute. 1% of the international transaction. 1% of the international transaction is what is the arm's length range. So if the international transaction is 100, 101 will become the arm's length range. 99 to 101 will become the international transaction. Or if it is 3%, it will be 103 or 97, depending on what is the transaction. So this is arithmetic mean if you have less number of comparables. If you have 6 or more, then they have prescribed a concept of multi-year data, and they have multi-year data is applicable for arithmetic mean also, but they have prescribed a concept of interquartile range, which has to be taken for calculating the median and the range. Now what it provided here is, first you have to make a data set of multi-year data. The multi-year data is current year, and you can go for 2 previous years, previous year 1 and previous year 2. So it becomes 3-year data set. So if I'm taking an external comparable, I have a company A. Suppose we are benchmarking for 24. So first I will see is whether 24 data is available. If 24 data is available, then 24 data becomes current year data. I can go for 23 and 22. So this becomes 3 years, right? So when I'm selecting a comparable, if the current year data is available, the test number 1 which you should apply is the current year comparable? That means if the current year data comparable to my transaction value. If it is comparable, then you can both adopt that as a comparable. Then you can also apply the same test to the preceding 2 years and then take the 3-year data also. When assessee does a TP study, the challenge all of us face is current year data does not get updated in the databases because we have to do TP study now. So therefore, the law does provide that you can take the previous year 1 and previous year 2, PY1, PY2 also has a basis of comparability, and those 2 years can be taken in the data set. After you form a data set of this form, after you form a data set of these 6 companies or 6 or more companies, arrange them in the ascending order. 35th percentile to 65th percentile becomes the range. They have given the methodology to calculate the range and weighted average also in the rules, Rule 10 CA. There the entire computation and examples are given. Compute the range for these two, 35th percentile to 65th percentile. The median is 50th percentile. If your transaction falls in 35th to 65th percentile, you are at arm's length. If you fall beyond the 35th or 65th percentile, then the difference from median becomes the adjustment. Difference from median becomes the adjustment. So this is something which is provided in the range. We could have possibly, because of lack of time, can't go into more detail. But this is something which at a practical level, if you see Rule 10 CA, they have given detailed examples of working of this, and that is something which you can easily read and adopt. Yeah. So with this, I will close the presentation, but if there are any questions, maybe we can take for 5-10 minutes, sir. Yeah. I hope I have sufficiently tried to keep you awake.
So, first 3 years, the company was followed cost plus method. So, because they were providing IT service. So, from 4th year, they have stopped the service and they were importing the machinery. And
you are purchasing machinery from the related party and selling to customers in India. As a part of contract, when I'm selling to customers, there will be a warranty period that up to 1 year if there is any defect or something which is there. Now, question comes is, with this after sale service cost which I am incurring, this after sale service cost which I am incurring, whose responsibility they are? Are they the responsibility of a trader distributor or are they responsibility of a manufacturer, right? So if you take a simple car example, you would take a car. For after sales you service, you go to the service showroom. But service showroom, in the free services what they give, they will have to cross charge to the manufacturer because that is how the model works. Suppose a part is gone in that particular thing, right? So generally in after sales service during the warranty period will, in a general sense, will always be a responsibility of a manufacturer. So when I do this after sales services, your terms of contracts with AE, what are they reflecting? Are they reflecting the real fact that this additional cost what I am bearing for after sales services, am I getting a reimbursement from AE? Situation number 1, right? Second situation, the agreement will say that after sales service is responsibility of a distributor. In that case, the distributor should always get a higher margin for taking this additional function. Not just the margin of a distributor, but also an additional margin of a service provider. So depending on the fact, you'll have to take a call. If the after sales service is more of a reimbursement transaction, then RPM is still a valid method. Because you purchase, sell, gross margin compared. Second transaction, I do an after sales service, 1,000 rupees I incur, I get 1,000 rupees reimbursement from my AE. It is comparable. There is no issue there. Now, if the after sales service is also responsibility of the assessee in India, then RPM may not be correct method because you are incurring cost over and above your distributor function, which gets reflected in your below the line item. That time the net margin should be taken under TNM in a general sense.
I can't apply RPM and TNM both.
You should not apply both. You should not apply both because 92C's mandate is select a most appropriate method. Which is the most appropriate method? See, I can justify by an alternate study by doing TNM and RPM, but to me, fundamentally, only one method should be selected as the most appropriate.
After sale service is very nominal. See, suppose 1 crore machinery, 1 lakh is the service cost. So you can't compare at all. So can we take there?
No. See, you will not compare. So suppose you are having this transaction, how will you apply both the methods? You can't apply both the methods, right? If you apply TNNM, it already incorporates the gross margin. Gross margin is already there, right? And the net margin is coming after this after sales services. So it is not that for the same transaction you will apply two methods. Now for a trading transaction, suppose for a trading transactions you apply RPM. For a expense transaction of after sales service, right? You can't apply TNNM. Independent, you can't independently apply. It is the same P&L. It is the same P&L.
One more question.
Yeah.
So the entity supplying services, so cost plus method they were following, and they have received some asset also. The asset cost incurred by foreign entity, so it is showing as a payable. Should we report that in 3CB?
See, as I said, fundamentally, if you ask a question whether payable is an international transaction or a receivable is an international transaction, under 92B, the way today 92B is worded, this is an international transaction. The first question is, the answer is yes. Okay. Now, should I do an ALP benchmarking for a payable? In case of a payable, this is more favorable to me. Now, when I purchased an asset, two questions you have to ask. Whether the purchase price of an asset, on what basis it is determined. So, did I purchase a 90 lakh rupees item at 2 crore rupees, or I purchased at 90 lakh only? So, did I purchase at a higher price and that's why they gave me a credit period? That is one question you should ask. If my purchase price in an independent scenario was 90 lakhs and 90 lakhs, that means the third party also this product is 90 lakhs and here also it is 90 lakhs, then there is no problem in payable because you can't make an adverse adjustment. You can't say that the purchase price should have been higher, therefore I'll claim more deduction in India, because that would be barred by 92(3). An adjustment which results in reduction of profit is not permitted. So that way it is an international transaction, but is it linked to your purchase price itself or is it an independent? That will depend on facts of each case.
If it is independent, I purchased
how is
a
it
laptop.
independent?
I
You
purchased
purchase
a
a
laptop
at
in
same
India.
price.
I purchased a laptop in India as an outsider. The cost will be borne by the US entity, just as a reimbursement.
No, you are a cost plus entity.
Yes.
What does your agreement say? Will you be bearing all the cost?
Expense cost, not asset cost.
Then why are they bearing?
Funds are not there.
No, that is not a proper answer. That is not a real life answer. Right?
So it's a practical difficulty.
No, I understand, but we are not looking at individual practical difficulties. There will be a different solution for those practical difficulties. Funds are not there, let them infuse equity, let them give ECB. There are various other ways to do it. Right? Okay. Yeah. So thank you everyone for patient hearing, and I thank Bangalore branch, and always it has been an opportunity from the branch for me to share my views and enhancing my knowledge. Thank you very much.
Thank you, sir, for deliberating on the topic transfer pricing, compliance, and documentation. On behalf of the managing committee members, ICA Bangalore branch, ICA Chandra Prakash Jain, managing committee member, once again, thank you for the wonderful session. I request our treasurer, CA Tupad, to present a gift voucher as a token of appreciation. We'll